Welcome to Yahoo Finance's flagship show, Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures holding on to gains this morning. That's after a drop of more than 2% last week for the S&P 500 and NASDAQ, despite a rebound on Friday. Didn't salvage the week. The bounce in futures coming even as crypto assets are still falling. Bitcoin back above $85,000. But it's off the highs it notched over the weekend. The risk-off sentiment coming as investors question whether the Fed will cut interest rates again in December. PPI and retail sales data due out tomorrow will offer more insight into inflation and the state of the consumer. Plus, in a reversal, the White House is expected to announce a framework to bring down healthcare costs this week. The administration looking to address an impending surge in health insurance premiums caused by Affordable Care Act subsidies that expire at the end of the year. Treasury Secretary Scott Bessent said an announcement is planned for this week. Politico is reporting that this framework would extend the subsidies for 2 years and add new limits on eligibility. Keep in mind, a fight over this subsidy extension, with Democrats supporting it, was at the core of the government shutdown. And now that shutdown has ended, airlines are expecting a record travel week. For the Thanksgiving holiday, airlines expected to carry more than 31 million people, according to Airlines for America. Carriers are hoping for a smooth holiday after thousands of flights were disrupted in the federal government shutdown, and it appears some flyers were waiting for the shutdown to end before booking. United Airlines said bookings between November 15th and 16th were up 16% compared with the prior weekend when the shutdown was still in effect. Let's get a check-in on stock futures. We are seeing a bounce that's going on this morning. And it's interesting because in recent weeks, Bitcoin has sort of been a leader of the equity markets. But even though it's down, obviously we're seeing futures up and NASDAQ futures leading gains up about 0.8%. S&P futures pointing to a gain of 0.5% at the open, and Dow futures pointing to a gain of about 0.25%. Let's dig into our top stories of the day now. Retail earnings on deck as stocks look to recover, and investors awaiting key economic data, plus crypto continuing its slide. Joining me now, senior reporter Brooke DePalma, live at the NASDAQ, senior markets reporter Ines Ferre, and Federal Reserve correspondent Jennifer Schonberger. Brooke, let's start with you. So coming off of last week, we are seeing a bounce continue here today. Not a super busy week, but we do have some more retail earnings on tap.
Julie, we absolutely do. A lot of these retailers were expected to do poorly as we made our way into the year. Now in the back half, a bit of momentum heading into this report as maybe things weren't as bad as they had seemed. We have a slew of different companies expected to report tomorrow, including Kohl's and Best Buy. We also have later on this week, Dick's Sporting Goods, Abercrombie & Fitch also out tomorrow as well. And what we're expected to hear is, once again, these retailers doing better than expected. Best Buy, for example, is expected to post an increase in same-store sales growth. They did post their fastest rate of same-store sales growth in the previous quarter since Q2 of 2022. That was their fastest growth rate, what they saw last quarter. We are expected to see positive momentum yet again as consumers really turn to those electronics, trying to get in ahead of any potential price increases. Now, Abercrombie & Fitch, they're an interesting one because they had an impressive quarter last quarter. The Q3 expected to also be an increase in same-store sales growth. But interestingly enough, younger consumers ages 19 and 20 going to their Hollister brand did well for them last quarter, and that's expected to be the case yet again in Q3. Last quarter, that particular segment within the Abercrombie & Fitch business saw upwards growth of more than 20%. Wall Street estimates it to be about 11% increase this quarter. And lastly, also coming out later on this week, on Wednesday, is Dick's Sporting Goods. This will be the first time that the company has reported, or rather the first full quarter since the acquisition of Foot Locker. And so lots of momentum and lots of insight that investors are looking to seek about how exactly the consumer is doing right now, especially as we make way into Q4, that key holiday season.
Yeah, and of course, going into Black Friday as well, we'll see how the numbers look on that day. We're going to be talking about that really all this week. Brooke, there's also some specific retailer news in terms of a leadership change at Kohl's.
Yeah, so Bloomberg reporting on Sunday afternoon that the interim CEO that's currently in place, Michael Bender, will be the permanent CEO at Kohl's after that change up last year, which then ended up leading to that CEO who was named, Ashley Buchanan, to step down. Now Michael Bender, the interim CEO, is expected to take the helm. We're currently looking for that announcement to break this morning. But what we do know is that Kohl's has really been a struggling retailer. Their same-store sales growth have been negative for quite some time. They have not seen a positive same-store sales growth since 2021. And this quarter, in Q3, Wall Street is expecting that Kohl's will post a negative decline when it comes to sales of about 4% yet again. And this retailer has really struggled to get consumers in the door. They have that Sephora business in store. And now the company is saying that, hey, maybe jewelry, maybe particular discretionary goods like that will get consumers in the door. But certainly Michael has his hands full as he is expected to take the helm.
And so we've got the retail earnings. Specific retailers we're watching. We also, of course, have Federal Reserve commentary. And really, that has been one of the main elements driving the bus over the past few weeks, has been these changing expectations about what the Fed is going to do. Jen, I think Christopher Waller was the latest to weigh in this morning, although he hasn't changed his tune lately.
Yes, it's actually going to be a slower week this Thanksgiving week for Fed speak. But we did hear from Fed Governor Chris Waller this morning, as you said, who told Fox Business in an interview that he still supports a rate cut in December because he sees a softening in the job market. He actually thinks we're going to see major downward revisions for the September jobs report to the tune of 50 to 60,000 jobs. He thinks, though, when it comes to January and through next year, the FOMC is going to take a meeting by meeting approach because there's going to be a deluge of data that really starts after the Fed's December meeting with that November jobs report, November CPI, as we go into more real-time data next year. And if there's any inflation pop up there, he sort of seemed to indicate that could give the committee pause. He was also asked about his interviews to be the next Fed chair. He said he spoke with Treasury Secretary Scott Bessent about 10 days ago. It went pretty well. He said he would be a great fit for the job and would continue press conferences after every FOMC meeting. So that was Chris Waller. On the flip side, over the weekend, we heard from Boston Fed President Susan Collins, who is a voting member for December, and she reiterated comments that she said on Friday, which is that she does not see a strong need for a rate cut in December, perhaps implying that she could dissent if the rest of the Fed were in favor of voting for a rate cut. Of course, no decision made yet. But I want to go back to the conversation we had on Friday, because that is when the tune was changed for the markets with New York Fed President John Williams, who said that he sees the option of a rate cut in the near term, that there was room for one. And that really changed the odds. And that, again, is so critical because he is one of the so-called troika. He and Chair Powell and Vice Chair Jefferson always are aligned. And the fact that he came out with that speech during a critical time when markets were really split about what is the Fed going to do, some analysts this morning posturing that perhaps Powell gave the New York Fed chair, New York Fed president, the blessing to do so, to sort of signal that to the markets. So again, that is still the comment over the past couple of days that has the most weight for me. We knew, as you said, Fed Governor Waller does support a rate cut for December.
Right. Yeah, it looks like that's how the markets are taking it too. But Ines, we talked about this last week, and it remains sort of confounding that what stocks are taking heart from, that is this perception that a cut could happen in December. Bitcoin's not really catching that bid as a result.
No, it's not. I mean, you did see it go up a bit over the weekend because of that expectation now of a Fed rate cut in December. But as one strategist noted, it's only a 25 basis point cut. If it were a 50 basis point, or if you saw even more dovishness coming out of the Fed, then you could see sort of a sustained leg higher in Bitcoin. But this strategist is expecting to see a bit of resistance. So even though we saw a bounce, he's saying that you may see resistance until you get more dovishness, really a lot more dovishness from the Fed. And one just important point is that We see now ETF outflows in November reaching 3.5 billion. That's the highest since February, which was 3.6 billion. So the bottom line, what's important here is that institutional investors seem to be on the sidelines or not allocating to Bitcoin. And if you take a look at the crypto market in general, since we've seen this big sell-off in crypto in October, you've seen $1.3 trillion of market cap from the crypto market in general that's been just wiped out. That's about 31% of the crypto market. So it has been a severe fall from those highs that we saw at least with Bitcoin. But certainly the institutional investors seem to not be allocating at this point.
And then the other thing we're watching this morning, crypto related, it's a Monday. Usually on a Monday, Strategy, aka MicroStrategy, comes out with the Bitcoin that it's bought in the past week. And I know folks are watching this very closely today, given the recent action we've seen in Bitcoin.
Yeah, and given the fact that the previous Monday that they had reported that they bought more than 8,000 tokens. So certainly because of and those tokens were bought at an average of about 102,000 per token, so around there. So because of the further slide that we saw last week, you would assume that Strategy has taken on more tokens, has bought more tokens, but we are awaiting to see if indeed they did what their announcement would be.
Brooke, Ines, Jennifer, thank you so much. Appreciate it. And coming up on Morning Brief, as a volatile month for stocks draws to a close, is the volatility here to stay? Plus, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Tesla, Novo Nordisk, and Oscar Health. First up, Tesla CEO Elon Musk saying the company designs and builds its own AI chips. Musk said his engineering team has already designed and deployed several million AI chips in its cars and data centers. Those comments appear to be lifting the EV maker stock, although we already knew that they built their chips. It maybe is just that this is a new generation of chip. Tesla's chip expertise would be monetized through self-driving cars and humanoid robots, which Musk has touted as part of the company's future, those shares bouncing by 2% this morning. Next up is Novo Nordisk. Its closely watched Alzheimer's drug trial did not show a significant reduction in the disease. Shares taking a hit on the back of that data, which used an older oral version of its semaglutide drug to try to stem the progression of Alzheimer's. Novo had described the trial as a, quote, lottery ticket should it have worked. But the setback is denting hopes for Novo that Alzheimer's could open a major new market for GLP-1 medicines. The company is already facing fierce competition from the likes of Eli Lilly. Remember, that stock just hit $1 trillion valuation last week. Lilly shares, by the way, are also slipping a bit this morning. And finally, Oscar Health and Centene, those stocks getting a lift on reports the White House will propose a two-year extension of Obamacare subsidies with new limits on eligibility. Both Centene and Oscar Health offer insurance plans under the Affordable Care Act marketplace. In fact, they're pretty heavily indexed to it. The administration looking to address an impending surge in health insurance premiums caused by ACA subsidies that expire at the end of the year. Friday's rebound in stocks was not enough to salvage returns for last week, and volatility has been sticking around, questions persisting about the sustainability of the AI trade. Joining me at the desk is David Miller, Catalyst Fund's Chief Investment Officer and Senior Portfolio Manager. Good to see you, David.
Great to be here.
Thanks for being here. So, listen, we're all trying to figure out what happens now, right? That there has been this surge in volatility. There's been new questions. There are a lot of questions about the debt that many of these hyperscalers, especially the ones that maybe don't have as much cash, are taking on for all of this. So what do you do after that sort of period of turmoil that we've had?
I think you try to take the emotions out of it and focus on what really matters and what's going to happen inevitably long term. I don't think there's any real possibility that 10 years from now we're not going to be using technology in a much bigger way than we are today. I think that's inevitable. If you look at these companies like an ASML or an NVIDIA or an Oracle, they're clearly powering that future and they're clearly getting great margins on it. And there wasn't really any doubt once you saw NVIDIA's numbers that things are actually coming through. I think the real concerns in the market are more in the private debt space, where you don't have that asymmetric upside that you have from technology, that there was just too much money lending to companies that weren't strong enough, that there's probably good reasons you could see some weakness in that type of debt.
It's interesting what you say about the sort of long term, because Rob Arnott of Research Affiliates was on with me recently, and he pointed out that if you look at the 10 biggest stocks in the S&P 500, and you kind of go back every 20 years, they're not consistent, right? And so even if you think that AI is going to be the dominant technology for the next 20 years, how do you know who 20 years from now, 10 years from now even, is going to be the company or companies that are going to win?
Yeah, well, I think when you look at the dynamic and what's really changed over the last 10, 20 years, we used to have a very different type of economy fundamentally 10, 20 years ago, in the sense that the companies that were dominating were not companies that were dominating the entire world with their product or service. So if you took a company like a Bank of America or a Citigroup, those firms, I mean, sure, Citigroup has some global reach, and certainly Bank of America does to a limited extent. But the companies that were the largest were not the companies that were getting high margins on their products across the world that everyone needed. I think technology really will continue to be in that space, because it's hard to see what has that type of ability to dominate global growth like technology does.
So do you think that there's sort of unlimited upside then, or do you think some of this has already been priced in? And, how do you, what do you do strategy-wise right now with these stocks?
Yeah, so I think if you look at what the world's likely to look like 5, say 10 years from now, the valuations on these companies are deserved, meaning they're recurring revenues, they're high margins, and they're growing with strong tailwinds that are pretty secular. Even if the economy takes it on the chin a little bit, like at 22, you don't see revenue growth stop continuing at those hyperscalers. You don't see those companies not continuing to deliver high margins and good EPS growth. So I think if you look at it from an exponential perspective over a multi-year span, it's pretty easy to see that those dominant companies are actually worth their valuations.
Okay, so do you just buy the S&P 500 because they're heavily weighted in that index anyway? I suspect you're going to say no as an active manager. How do you think about it?
So I think, there's those old sayings about it's not good to predict things, especially about the future. But I think there are some bets that you can say are safe to not make. Meaning, like, we have this one fund, it's called the Monopoly ETF, MPLY. And what we do there is we just focus on those companies that have great growth, have dominant market share, oligopolies or monopolies in their industry. And you can see that EPS growth continuing. Whereas if you look at a company like an airline, they've got to pay to fly those planes no matter what's going on, no matter how bad the demand is. They got to pay those pilots and stewardesses no matter what. They never have a whole lot of pricing power. So if you take all those businesses that don't have those characteristics out of the S&P, and you just put yourself in those companies that have that type of dominant characteristic, I think it's fairly easy to say that over the long run, those companies that have real moats should outperform the rest of those that are in perfect competition over a long period of time. So I don't think you have to predict the future. I think it's best to just eliminate the losers.
Gotcha, and focus on things that have strong businesses now, rather than sort of predicting the future.
Exactly, yeah.
So what happens between now and the end of the year and going into early next year for stocks broadly?
I think we're still headed for a pretty good market, not because things have to actually grow that much in terms of real terms, but if you look at what's going on from a macro perspective, they're talking about giving out $2,000 checks to everybody.
Of course they're talking, but David, is that really going to happen? You can't bank on that.
You can't bank on that, but they already have it enshrined in law that we're going to be running a $1.9 trillion deficit. That's quantitative easing, whether you like it or not. They're just increasing the money supply. Nobody is seriously believing that we're ever going to pay down that debt. We're just going to keep expanding it and debasing the dollar. If you're debasing the dollar, stocks should go up.
Gotcha. Okay, so that is broadly, I guess, a good backdrop. Is there a big risk that you're worried about?
I think the real risks to the market are conceptually what happened in 2022. If inflation really gets out of control and the Fed has to do something to address that inflation at the expense of the economy, that's where you have a problem. But nobody's imminently talking about rate hikes. The questions are we going to keep it the same or cut?
Do you have concerns about the labor market?
Yes and no. I mean, the people are concerned, but when you look at the last jobless number, we're still looking at numbers in the 4s. if you're looking at numbers in the fours and the government's spending a lot of money and you're seeing decent GDP growth, will it weaken some? Sure, but that probably actually makes it a little easier to manage inflation expectations. I think we're kind of in a bit of Goldilocks perspective in terms of the unemployment picture.
Gotcha. All right. Well, Dave, thank you so much for being here. You're actually going to stick around and be here in the next half hour, too. And coming up on Yahoo Finance's opening bid, our executive editor, Brian Sozzi, is joining us now. Soz.
This is salmon. It's not pink, Julie. It's not pink, so don't even go there.
Pink is a shade of salmon. There's nothing wrong with it. I just hadn't seen you yet today.
I'm all about
liking it.
Well,
that's
it's
all.
good to see you, Julie. I appreciate that blue, and I like my salmon. So we're going to dig into not the color of my sweater. We're going to talk about crypto, why that is still important. I mean, the numbers on the sell-off are adding up. Also, interesting note out of Goldman Sachs, they're staying bullish on stocks, Julie. I guess that's no surprise, right? Because what do you expect to hear from an investment bank?
I guess so. Maybe I should view your salmon as a lightly bearish indicator.
This is a bullish indicator on life, Julie.
Oh,
bullish
okay.
indicator.
All right, I'll take it that way.
Yeah.
All right, thanks, Sas. That does it for Morning Brief. We got much more ahead on Yahoo Finance. Not deep sweater color analysis, though. It'll be market analysis. Stay right here.